answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hanson and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hanson.
I'm Pat McClain.
Glad you are joining us on this particular weekend because...
It's been a week. It has been a week. In every asset class.
It's been a week, yeah. Everything.
Gold.
Did gold finish the week down? It went the other direction.
Bonds have been all over the place. Of course,
the stock market.
Naturally, the stock market. Double whammy, if you will. Right. So if we open the week on Monday, the coronavirus was, it hit the shores of North America in a big way. Right. Which is it can no longer be ignored by either businesses or politicians or the average American.
That's right.
Can no longer be ignored. And we'll spend a little bit of time. And then what happened with the price of oil, which was essentially a feud between Saudi Arabia and Russia,
and America. Well, part of it was Putin trying to kill our shale producers.
Yeah, well, they weren't part of the agreement, but they were being affected by it.
And we'll talk quite a bit but if you came into this week, the last few weeks, with a broadly diversified portfolio with the right kind of asset allocation, where you've got you're structured in such a manner that you've got your anything in long-term investments is really for your long-term.
Long-term.
You're fine.
Yes.
However, if you had structured your portfolio to maybe maximize your income by having extra in energy because they paid higher dividends.
Yes.
Bloodbath.
Absolute. Just, you got your clock cleaned.
And I don't know if there's the overall markets will clearly recover. Not every individual company. Clearly, there's going to be people that
there will be fallout. If you were overweighted in either entertainment or travel and leisure, it was bad. It was bad.
It's just an interesting time. So, I mean, we're recording this. This is being aired on the radio Saturday morning. We recorded Friday afternoon, and it is one of the most strange. This week reminded me a bit of 9/11, and because Pat and I have been working together. Our names.
I remember absolutely 9/11.
Yeah, of course you do.
Oh yeah. Well, not only 9/11, but how the clients reacted to 9/11 and how we
did
reacted as a firm.
We were a small organization then, but 9/11. I remember we all came in. It's like, what should we be doing here? What communications we put out to our clients? All hands on deck.
What are our portfolios? And quite frankly, the portfolios need to be tested. Well, we do it on a weekly basis before it happens. It's after it happens. The horses left the barn, as Ross Perot would say. It's too late. So you need to build the portfolio to weather things that you can't see coming.
I mean, it's good for everyone to truly understand this particular time we've talked about it all the time. But what ends up happening is as this bull market continued to go for 12 years, people got complacent, didn't really pay that much attention, let their stocks increase.
Without rebalancing. What is rebalancing?
We talk about...
Well, maybe people are just listening for the first time.
Okay. By the way, this too shall pass.
This too shall pass.
Historically, the stock market, the last 96 years, if we look at the broad U.S. market as measured by the S&P 500, has grown about 10% a year. We've had many times where the markets have taken a big fall like this. And if you think back of other times, other shocks to the system, which we've had many, We've always recovered from them and moved forward. I really don't think the economy is going to be screeched to a halt forever. I don't think coronavirus is going to kill every human. We will get through this. 5 years from now, things are going to be much different than today.
It could be over, and it could be over. The recovery could start in as little as 6 months or 12 months. I mean, we could be back to a new high on the stock market in 2 years, or it could take 3 years, or it could be a year.
What's happening now is people are looking at long-term investments and are completely ignoring that things are going to recover, right? So what's the value of a company, any company? I call it a corner gas station. It's how many cars they're going to be able to fill, how much gas and now it's sodas and junk food can they, what are their sales going to be over the next many years, and what are they going to be earning over the next many years?
Not the next 3 weeks, 6 weeks, 8 weeks. So it most certainly will affect the value of those, much like if you have a rental house, you own a rental house, and you try to sell it when it's empty or it's been empty for a year, it's not going to sell for as much. Same thing.
My son's a senior at Boston College.
Yes.
Right? We both have kids in college coming home because Boston College says we're moving to online. My son, there's 5 of them. They rent an apartment, some flat in Boston. And so I was talking to him this morning because I said, when is your lease up? And they were actually looking at the contract, and there's something in the contract, an act of God, force majeure. I'm not a legal expert. I said, well, it'd be kind of interesting to look at the contract. And he says there's 5 months left on the lease. And I said, maybe the thing to do is go to the landlord and say, look, we'll give you 2.5 months worth of lease payments today. It's going to be, so this ripple effect. I don't know any business that's not impacted, but it's not going to last forever.
That's right. And quite frankly, Scott, the Fed cut short-term interest rates by 50 basis points.
0.5%.
0.5%. Thank you.
1 basis point is 1/100th. That's what we talk in the industry all the time.
Okay. Thank you. I forgot I was on the radio. So will that spur the economy on? Not if people can't spend it. Not if you're not going to go out. Right?
You look at the shutdown in Italy. Will that come here? I don't know. We don't know.
Well, quite frankly, so if you read, and I know you've read about it, but if the listeners, you go on, and what they're trying to do is flatten the curve.
Yes.
Flatten the curve. So go to Google or Bing or whatever and look up flatten the curve.
I think that's probably the best. For me, when I saw that chart, and it made the first time it really
made sense.
Which is essentially, we don't have the medicals, and by the way, we're not experts at this. We're not pretending to be experts. We're just giving you our opinion, what we understand thus far. But medical experts cannot deal with if the virus spread through in the next couple of weeks, they couldn't deal with all this truly sick people.
And they would have to then start rationing.
Yep.
And those affected would be the old and elderly.
And there'd be a lot more deaths.
If
instead they can slow the spread, essentially the same number of people might get critically ill, but you can spread it out over months. Now the medical community can deal with it.
And it gives the medical community time to ramp up for this, to train to it, to get supplies, and that's really, quite frankly, if you look at how China handled this, how Germany handled this versus how Italy handled this, Italy was too late to the game. China, we may
be too late to the game.
What's that?
We may be
too late to the game.
All right, we'll find out soon.
But it's interesting, in China, they're starting now. So this whole started in China at the end of December. We didn't hear about it in the United States until early January, and no one paid a whole lot of attention unless you're an infectious disease specialist, in which case you've probably spent a lot of time watching this. But China has now started to reopen factories. And
so from an investor's standpoint, when there's times like this, number one, it creates opportunity. So if you had some cash wondering when is a good time to invest, we don't know if it's at the bottom, but the best time to invest is when there's uncertainty and fear, which is clearly now. This is a horrible time to be selling.
Yes.
And if you have your portfolio being managed where it's being rebalanced, it might have already triggered a buy, or it might be buying more. So as an example, here at Allworth, and I know that many of other firms, similar kind of approach, let's say that there was a client that had a portfolio that was 50% in, let's say it was 50% in equities or stocks and 50% in bonds and some other things. So roughly 50% at more longer-term investments and 50% in more short-term investments. After last year with the stock market run-up, instead of it being 50-50, it might have suddenly been 58-42.
Because the equity side of the portfolio
Grew.
has grown and the other, as a percentage, has shrunk.
Yeah, so-
Not that it lost value, but as a percentage, it was less.
So
to the
I know at Allworth on February 20th, we did a cross-the-board rebalance, and for accounts that were in IRAs where there's no taxable consequences, it was just automatic where we sold off some stocks. It was right, essentially, I mean, in retrospect, it looked like we had some brilliant timing, but it wasn't that at all. It was just the disciplined approach to investment. And at some point in time, they'll be buying back more. As a firm, back in February of 2009, right before the bottom of the market, not because we saw it coming or we were clairvoyant that this was happening. It was a disciplined approach.
What happened back then is we actually sold bonds and bought stocks about, 3 weeks below?
Yeah.
3
weeks before bottom.
Before the bottom. Not because we knew we were at the bottom, but we had a disciplined approach to doing the
Yes.
asset management. So when you talked about the IRAs, the reason we do it in an IRA is because there's no tax implications. On a brokerage account or dollars outside of an IRA, then we measure that against the tax implications
And see what
then
makes sense.
What makes sense. We thread the needle.
If you right now are kind of panicked about things, a couple things to do. One is look at what is your approach to investment?
Do you have one?
Right, and I think a lot of people don't.
Well, they didn't have a discipline around it.
Well, they're feeling that now if they don't. But maybe you'd had that. But I find for some people it's just helpful to see to understand what's in your portfolio right now. So what I found is sometimes people think, oh my gosh, my $1 million is going to go to zero if the stock market goes to zero. First of all, you probably don't have everything in stocks. So understand what's actually in your portfolio. And it might be that only half of your account was tied up into things like that, and the other half is very safe. So even if every company in the world went bankrupt, if that happens, it's not going to matter.
It's not going to really matter.
That's not going to happen anyway. But
that you have something that's that can ride you through, especially if you're taking income on a portfolio.
Yeah, and I know as a firm, this last week was a really interesting week for us, right? So as an organization, we're doing a number of things. One, we've had a variety of communications going out to our clients. As a matter of fact, we put together a video, a 15-minute educational video, navigating financial shocks. It's on our website. There's a link to it at the front page of our website, Navigating Financial Shocks, and it goes through other financial shocks, how the markets are reactive. I think it's very helpful for investors to get it's 15 minutes, right? So if you're
allworthfinancial.com.
Yeah, allworthfinancial.com. It's really helpful to do. So we put that together. We got together as an organization and said, all right, let's pretend like we're locked out. Everyone's working from home. How prepared are we? What do we need to do, et cetera? So we're not there today, but
we'll be there by the middle of next week.
We could be.
We were a lot of the ways there, but this kind of forced it.
But it's being in that position to make sure that we can continually communicate with clients. History's shown people that make big changes to their portfolio during times of panic harm themselves.
Yeah. And the last thing that we did was we had these we would do live events, Social Security
We had
workshops.
22 workshops scheduled in the next couple of weeks around different cities.
around
you've
the
heard our
United
ads
States.
and stuff. And we
well,
talked
we
about
hope you've heard the ads.
And obviously, we can't very well host something where we have hundreds of people over age 60 show up to in person.
Yeah. So we reformatted our live events with Social Security workshops, which we teach you about how your Social Security works and when you should take it and things that you need to be aware of. We've actually reformatted that to a on-demand.
And essentially,
it's the workshop.
I'm going to do the workshop along with one of our other financial advisors with cameras, with lots of cameras and highly produced. So you'll have the exact same feel. So if you signed up, you'll get that. If you haven't signed up, you can still go to our our website and grab that.
Yes.
So
and actually, and if you subscribe to our weekly newsletter, you'll see that.
And if you thought you're subscribed to our newsletter and you didn't receive it Friday, go back on our website and sign up because maybe you opted out or something else happened. So it's on your spam filter or something. But we want to make sure you get that because we've been having lots of great information. But we also want to continue on. Life goes on. We want to make sure we have some calls. So we're going to have some calls. We're also going to talk to our CPA Michael Mariski later in the program. So let's go to the calls. And let's talk with Bob. Bob, you're with Allworth Money Matters.
Thank you very much for your time.
Thank you, Bob.
What can we do for you?
My question is that I'm approaching my retirement in about 3.5 years, and I currently have about $500,000 in my 401k. And in addition, I have about $200,000 in the equity in my house in the Bay Area. And my retirement income will be about $2,850 from Social Security. And if I don't touch my 401k, it'll be about $1,500 a month from that. But my question is, I'm going to be looking to purchase my retirement home. And the question is, do I limit my house hunting for retirement to only the $200,000 that I have in house equity? Or am I able to take some money out of the 401k and buy, say, the house I really want for $250 or so? And then how much damage does that do, and what are the trade-offs, I guess?
How old are you?
I am 63 and a half.
And are you single or married?
Single.
And when you pass away, where does this money go?
If there's anything left, it goes to my 2 kids and to my grandson.
Okay. And how do you feel about that? Do you care that they get it? Are you one of these guys that say, the last check I write, I want it to bounce? Or are you someone that says, it's really important for me to have my children inherit? Or do you just completely up in the air one way or the other?
No, the only thing I care about is helping my grandson with college. Other than that, I want to go sliding into home and leave just enough to bury me.
All right. So I have. I'm going to ask Scott what you think because I
would consider using a reverse mortgage to buy this house.
I would consider using a reverse mortgage to buy this house.
And how that can work? Let's say the house is $250,000. Essentially, I'm just kind of making up some numbers here, but you might need to put like $125,000 down. The reverse mortgage covers the other $125,000. What ends up happening is because you've got a mortgage on it now, you're not making payments on it because you don't have to with the reverse mortgage, and the interest just accrues on itself. So 5 years down the road, instead of the reverse mortgage balance being $125, it might be $150 or $160. And 20 years down the road, it'd be substantially larger, but one would presume that so would the value of the house you're in. The nice thing about it in a situation like yourself, and we don't recommend these very often, right?
And when we're through talking about the nice situation, we'll go through the pros and cons of this for you.
But that way you're not dipping into your 401k. I really don't like the idea of you dipping into your 401k for your house if you don't have to. One, you've got to pay taxes on the money coming out. Two, that's less principal there to work for you to provide some monthly income.
You said your Social Security income would be how much a month?
About $2,800 to $2,850.
At what age?
At 66 and 4 months.
Yeah.
Okay, all right. And when are you moving?
As soon as I hit 66 and 4 months.
Got it. So you got 3 years.
Right.
So I agree with Scott. So the problem here's the downside of the home equity or the reverse.
Well, first of all, it's 3.5 years. A lot can happen in 3.5 years.
That's right.
I mean, real estate prices where you're going to buy could go up. Prices in the Bay Area could go down.
Lots could happen.
Reverse mortgage products can change.
They might not be available. Who knows? But if you were to make the decision today, we would say do a reverse mortgage. The downside of it is you better make darn sure it's the last house you're ever going to live in. So you got to go in there knowing that this is fairly close to an irrevocable decision. The other downside
it will definitely be my toe tag house.
Okay, So you, if it means you're moving to a place you've never lived before, or haven't spent a lot of time in all the seasons, I would ask you to go and try to experience every season in that geography, as well as spend time there to make sure it's the last house. The other thing is that they're expensive. They're more expensive than a regular mortgage, but it satisfies your needs, which is to preserve as much principal as possible in order to actually live off of that. And, at the end of the day, would there be more money left over in the property if you paid for it? Yes, absolutely, because you'd be paying down the payment. You'd be paying the interest and principal every month. And all this is, a reverse mortgage is just exactly what it sounds like. Mortgage in reverse, which is the payment that the amount that you owe on it goes up every month, not down.
Right.
And that's what I would explore in your situation. Partially because you're single, partially because you said, if they get something, they get something. If not, who cares? And you're not flush with money. You've got probably enough, but it's not like it's rolling. And $200,000 in equity in a home at 63 is nice, but if you're moving in and around California, as well as I, that is not a lot of equity in California.
No, I'll be heading to the border of Idaho and Washington State, and where I've lived before.
Okay, and perfect. You might actually be able to pay cash for a house there for the $200,000, or if you just need a little bit.
What cash do you have now?
In addition to the money in the 401k.
Additionally, I have about $45,000 cash in the bank.
You might be able to swing it, depending upon, we're talking 3 years out. I don't know what kind of a house you're looking at up there, but if you could pay cash for it and then just keep that reverse mortgage on the side and decide to do it in the future.
What if you sold your current house now and bought that house today? And found somewhere to rent for the next 3.5 years.
And turn that into a rental?
Thought of that. That would be interesting to take a look at. I know I could rent it for more than my mortgage.
I'd play with that. I like that idea.
My mortgage is only $1,433, and I could.
I've been doing this almost 30 years, right? So I've seen lots of different economic cycles. I have no idea what's coming in the next 3.5 years. I can't predict anything, but you've lived there before. You're a single guy. You're counting the days down for 3.5 years for retirement.
Yeah, can you get a job up there?
Don't need a job.
Yeah, that's 3.5 more years in the Bay Area, and he's done. But if you can sell, right. We know what your house in Danville is worth today. We don't know what it's worth 3.5 years from now.
Right.
If you sold the house, and we know what houses are worth it's about $250,000, the house that you'd like to buy. Part of my thought is, what if you sold that house
in the Bay Area,
and then rented something for the next 3.5 years,
and then bought the house up in Washington State or Idaho and rented that out.
You'd want to buy. You wouldn't want to wait 3.5 years because then who knows?
Yeah, what side of the trade you'd be on.
Yeah.
That's something to consider.
Something to consider.
So there you go. You got two things you can do, one today and one in 3 years.
Yeah. Good luck, Bob. I like the plan, though. Sounds good.
Thank you very much. Yeah. I appreciate your advice and enjoy your show. Thank you.
All right, thank you. Yeah, and it
is really expensive to live in the
Bay Area?
Yeah. Well, in most of California.
Even like gasoline is double. I go to visit my daughters, and we live here. Pat and I broadcast. We live in Northern California. My daughter's in Denver in grad school, and the gas is like half the price.
Yes.
Utilities are expensive here.
That's expensive. People were nicer.
I don't know if people are nicer. Before we go to the break, it's important to look at your employer's financial situation if you've got a deferred compensation plan. So some companies offer a 415 deferred compensation plan, or you have a pension that is larger than under the federal guidelines, and they have to provide 415 pension benefits.
So just to be clear, we're talking about private companies. Because you could have a deferred compensation and be part of a municipality or water district, which, by the way, technically is an asset of that municipality or that district, and they're called 457s, not 415.
So we're headquartered in Sacramento. McClatchy newspaper chain just filed for bankruptcy a few weeks ago. Prior to that, they suspended the excess pension benefits to their executives that had previously retired because they were just a liability
that they could discharge. They
Yes.
could discharge them. They did that before they filed for bankruptcy.
Correct. The reason we're bringing this up, if you have a pension or you plan on having a pension from a smaller employer and you think there's some chance, if the pension is in excess of the IRS limits, that executive type pension, plan around that because there could be some changes there.
Yeah. And it doesn't matter what industry you're in, because you could have retired from the newspapers 25 years ago and thought you were absolutely golden.
That's right. That's exactly right.
Right?
Correct.
Like you're like at the top of your game.
Right.
Nothing going to upset this.
No kidding. All right, we're going to take a quick break. And when we come back, we'll take some more calls. You're listening to Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
All right, welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
And glad you're before in this part of the program, we want to talk a little bit about taxes because here it is, middle of March. And what more exciting topic?
What a great.
So we're going to have a CPA be joining us the latter part of the program, and so you want to stick around for that. Our very own Michael Mariski. Allworth has a tax department that does
Allworth Tax Solutions.
Yes, Allworth Tax Solutions. But Michael will be joining us to talk about some techniques and whatnot.
So when we say we have a tax department, it is a service that we offer to our clients as well as financial planning and investment management.
Yes, they do.
Another bookkeeping,
returns.
tax returns.
Not that much bookkeeping because most people it's or the tax returns.
Yeah, but they do business tax
Shredded tax
returns
returns.
and
Yeah, yeah.
tax planning and everything you'd
And tax
expect.
planning,
You'd
yeah.
expect from a professional firm.
Okay. All right, but before that, we'll be talking about some things to pay attention to as we're going into tax season here. But before that, we will take a couple calls. 833-99-WORTH is the number to be part of the program. And let's start off here with Brent. Brent, you're with Allworth's Money Matters.
I'm a guy who's always paddled his own financial canoe. I've listened to you guys for years, and I've certainly learned a lot. And I'm coming to you today asking about the topic of Social Security claiming strategies.
Oh,
The situation is
we hate
that,
these. We
yeah,
hate
that's
these
how I feel
questions.
it.
We hate these questions. And
I'll
let me tell you why we hate,
this
Brent, before you ask the question, I'll
Yeah.
tell you why we hate the question. It is such an individualized answer for everyone based on a number of factors, right? What you're trying to achieve, high current income, more money downstream, right? What you believe your life expectancy is and what your income needs are today. And
it's more than that. Do we have a high amount in retirement accounts relative to other assets? Is that where income's going to come? Are there Roth conversion strategies that we should employ between now and age 72?
Is there pensions involved? And we use sophisticated software in our office for all our financial plans. But in saying that, we'd love to take your question.
And the rules have changed based if you were born before, what's the year, Pat? 1940?
46? Is it 46? 46. Anyway.
No, is it 46? Go ahead.
Anyway, what's your question?
Well, the questions are broader than that. I'm definitely not looking for a specific recommendation for my wife and I. And here's the background. I was born in 60, my wife in 61. And, I have always taken the position that I just blown that topic off. I pay very close attention to all other personal finance issues. But I said, or thought to myself, the laws are going to change 3 times before I become eligible. Don't worry about it. And so, but my questions are is it really this? A, is that really the right way to look at it? Should I be doing more investigation in this now when I'm turning 60? And if so, where can I educate myself about it?
Well, our website's got a pretty good tutorial, right? So, one way is if you just go to allworthfinancial.com, I think we have a learning library. Learning library. We've got I think it's a 40-minute tutorial that goes through everything you need to know about Social Security. You spend 40 minutes on that, you'll have as much.
Is it
education.
a video?
It's I don't know
What is
yes,
it?
It's a video.
It's a video. Did you do it?
I think I did.
Scott did it.
So,
Oh, you did it.
okay. So we really try to have a lot of tools on here to help people. I apologize for not remembering sometimes. I don't remember what I had for breakfast this morning.
So that's one way, and it's a tutorial that gets you thinking about these things.
But you do want to educate yourself because there's some people it makes sense for them to start taking Social Security as soon as possible at age 62. The majority not, for sure. But for some people it makes sense too. So that's 2 years off. So you'd certainly want to know how it all works within the next 24 months.
And then the other thing that we don't know the answer to that you'll have to actually judge for yourself, and you may have, if you've listened to our show any amount of time, you know how we feel about this, which is the higher the income you have in retirement, the more likely that the government will take away your Social Security benefit when they are running into more difficult financial situations than we are today. So if you're going to cut Social Security benefits, you don't cut it on the person that's living on $15,000 a year. You cut it on the person that's living on $150,000 a year.
Or 300 or
whatever the number is, because it doesn't change their lifestyle as much as it will change someone. And the whole Social Security, how it's paid out, is actually the lower the income you make while you're putting into it, the higher the benefits as a percentage of your earned income you'll receive in Social Security. So you can go through the whole practice of when to take it, and you might decide that the best time to take it is 67 from a number standpoint, but you worry about the legislative risk.
But it also depends on if he's retired and has any other wage income.
That's
right. Why you need to learn some of the rules. Because you can't take it early if you're still working.
Yeah.
Right.
Yeah.
Right. And I probably won't, but my wife may very well take it early due to health concerns. I guess what I'm getting from you is that, what I'm concerned about is I go through this process and I learn everything, and then the law changes next year.
Oh, yeah.
Or the year after that.
Oh, yeah.
So
it very well could happen.
At any rate.
There's not going to be any major change on Social Security in the next 24 months. I can't imagine what would happen politically in Washington for the Democrats. It's the third round. No one wants to touch it.
In the next 24 months.
And Social Security is going to be bust in about 2032, so about 12 years from now. My guess it's not going to be. It won't be addressed until 13 years from now. That would be my guess.
It hasn't really been adjusted since Reagan, right?
They've increased taxes on it.
Well, they increased tax. There's that part. They moved the age out under Reagan, but at any rate.
But it was after that where they started taxing. They went from 50% of your benefits being taxable to 85% of your benefits being taxable
on incomes over $44,000.
So for high income earners, it was it's more than a 10% reduction in their benefits, which was that's what that equated to, greater than a 10% reduction in benefits.
But it never showed up on the benefits; they just taxed you on it.
That's right.
So and what was the level that they consider high income?
$44,000 for a couple. And so originally, originally they were taxing 50% on $32,000, and there didn't seem to be much of an uproar, and they're like, hey, this is kind of working. And then they said, okay, between $32,000 for a couple and $44,000, we'll keep it at 50%, but over $44,000, we'll keep it at 80. We'll move it to 85%, and they never adjusted that for inflation.
That was 1998.
Never adjusted that for inflation. So.
Okay, well, I will start with your tutorial.
All right, and one other thing: if your wife has serious health issues, and you believe that there's slight chance that she might qualify for Social Security disability, you should look into that.
Well, to be totally candid, I won't get into all the details, but I will do that.
Okay.
Yep.
All right. Appreciate the call.
Yeah. Wish you well.
Thank you, gentlemen.
Thank you. Let's continue on. We're going to Cincinnati, and we're going to talk with Joe. Joe, you're with Allworth's Money Matters.
Hi, Scott and Pat. This
Hi, Joe.
is Joe. I'm married, 65, and trying to plan for the future. I was looking in my required minimum distributions, which now must be taken at 72 because of the Secure Act.
That's right.
That combined with Social Security might push me into a high tax bracket. And I was wondering, what the present tax brackets are, because I'd like to convert some of, but not all, my 401k and traditional IRAs
Perfect.
to Roth IRAs in order to minimize future required minimum distributions.
Are you working now?
Yes, I am.
Okay,
probably for another year and a half. I'm
Okay.
winding down.
And is your spouse working and plan on
No,
working?
she's not.
Okay, so it's just you. And what's your approximate
Yes.
income?
I'm in about presently between 150 and 200,000.
Okay, so we know that you're probably not going to do any Roth conversion between now and the time that you're still on payroll, or maybe even the calendar year that you're on payroll.
Okay.
After that, I like the way you're thinking, but I really do. You're just too premature in the decision-making process to actually get the right answer. So once you retire and you determine what your forms of income coming are, you'll know what your taxable income will be and approximately how much you need to live on. Then you actually work with an advisor or a CPA or an accountant to determine how much room there is between that existing tax bracket and the one above that. You take the IRA balances, the qualified plan balances, and you put a growth rate on it in order to calculate what your required minimum distribution will be at age 72. But it's too premature to do that because you're still working.
Okay.
So we know that and it depends on what you're going to live on and what your assets are, and what you can control in terms of the distributions and what you have no control over. So some accounts, if they're outside of an IRA, many people don't have a lot of control over the taxable distributions from that. But your thinking is right on.
And here's where the tax rates are, just to give you. So,
Okay.
here's
Where
how
they are today.
for 2020. Yes, for 2020. So the first $20,000 of taxable income for you're married, is
Yes.
at 10%. But we need to factor in a standard deduction. And the standard deduction is almost $25,000, $24,000 and some change for standard deduction. So, and it's sometimes misleading because people pull up a tax table and they say, oh, well, say taxable income here, here's the tax brackets, but it doesn't take into the standard deduction. So I like to think of it still of, because 90-some-odd% of Americans are on a standard deduction now, what is the tax bracket with the standard deduction? Now we're talking about the tax bracket doesn't move from 10% higher until after 44,000. So if we factor in the standard deduction, we're in a 12% tax bracket from 44,000 to 104,000. Then it jumps from 12% to 22%. From
what's the top of the 22% bracket before you go to 24?
It's 171,000, or think of it, it's about 195,000, including the standard deduction.
Okay.
So unless you think
And then
you're
it goes
going
to 24
but so Scott, unless you think your income is going to be that high after the day you retire, that's why you wait to do the Roth
But
conversions.
Jim, just briefly, then it jumps at 321,000. It goes to 32%, from 24% to 32%, then to 37%, then to 35%, then 37%, plus over $250,000 roughly. There's the Obamacare tax on which gets hit on a good portion of income. So it's
there's also a
state.
A penalty on your Medicare Part B if
That's
you
correct.
exceed 218,000, correct?
That's correct.
All right,
And
well,
that
I'm gonna-
Medicare Part B gets getting more.
I'm going to stop both of you for a second. It's not an Obamacare tax, Scott. It's the Affordable Health Care Act. And it's not a penalty on Medicare. It's a fee. So I'm just kind of your language.
Oh, okay. Well, the fee only goes from $202 a month to $289 a month, correct?
It is another tax that you need to consider when evaluating all these things.
That's correct. But
Okay.
but what we know is based upon your income today, you're going to have some planning opportunities in the future, but not now.
Okay.
Scott?
Correct.
That sounds good.
All right.
All right.
So
Well, thank you.
appreciate
All right.
the call.
Wish you luck, Joe. And I like, frankly, I don't know why they don't have more. Whenever you pull up these tax tables, I like thinking of it with the standard deduction in it because,
It makes sense.
and of course, the best way to do this is actually crunch your own numbers, just not using the.
But there is great planning opportunities. When this Secure Act came out, it gave a lot of people like Joe another year and a half for planning for required minimum distributions,
Yeah,
which was a positive thing on there.
that is correct, particularly if required minimum distributions are going to be an issue for you.
But another thing that the Affordable Care Act it's got, and I don't think we talked about this on previous shows, which is if you have multi-beneficiaries in your estate, and some are high earners and some are low earners, you would want to get those after-tax dollars directed to your high-earning beneficiaries and the IRAs to the
Which
low.
after-tax dollars?
So if I had $1 million in an IRA and I had $1 million outside of an IRA, if the normal people would say, okay, they're just going to split it evenly between my two beneficiaries. But the reality is there's a tax advantage to have
Correct.
the IRA go to the lower income tax earner, the lower wage earner.
But it's not an equivalent.
You can do the math, though. I know it's not equivalent dollar for dollar. But because after-tax dollars move on a stepped-up basis and IRAs don't, there's a planning technique there to keep more money inside of the estate.
So let me get this right. So there's 3 siblings inherit money.
Yes.
And the wealthy one is going to talk to particularly the one who's not wealthy at all, and say, "Yeah, here we're going to change some things around. So I've calculated the numbers, and you're going to get less cash, but you're going to have more in your retirement account because see, my tax bracket is at this level, and yours, because you don't earn any money because you don't really work, is at this low level. So sign here, please, and I'll see you Sunday for the potluck."
Yes.
Okay. Good luck on that.
Or the family naming the
understand
beneficiaries could do it.
Okay.
It is. You're right. I mean,
in a practical, how can you do that?
theoretically, it sounds brilliant.
Yes, it's
Because it involves people, it somehow won't work.
of course. And the person who's not any money is going to think the other one's trying to take advantage of the situation.
Well, they're not taking advantage of the situation. They are taking advantage of the situation, not to the detriment of each other.
But they would.
That's probably not how it would be viewed.
That's my guess. So.
Well, we didn't have to worry about that when we inherited money in our family.
Okay, now we're going to use the latter part of this program to talk with Michael Mariski. He's heads up Allworth's tax services, because we do provide income tax planning and preparation for not only our clients but for others as well. So many of our financial planning clients are also utilize the services of our tax department, but there's also some people that just use our tax department, which is
and
fine.
there's also people that just use our financial planning and have their own tax
absolutely.
services.
We find many enjoy
A unified approach.
but those that don't, that's fine as well. Anyway, Michael Mariski, Michael, thanks for joining us today.
Sure. Happy to be here.
So, how has your world changed, and how's the typical accountant's world changed in light of this coronavirus? Because here it is, we're at the middle of March. Taxes are supposed to be due middle of April. There's discussion that we're going to extend the deadline. So what's happening?
Right. Well, I think it's at the moment, at least for us, it's kind of business as usual. There's the corporate tax deadline, which is Monday, normally March 15th, extended to the 16th because of the weekend. And of course, as you mentioned, the April 15th deadline. Most of our clients, I think even if there's an extension of the deadlines, which is what's being talked about by Trump, nothing's official yet. I think most clients are going to want to file, as usual, especially if they're getting refunds. They're going to want to just file and be done with it. So I don't know that it's going to change much for us. Maybe a few people that will go on extension, which would be helpful because there's so many tax returns to do in such a short period of time. But, again, for the most part, I think it's business as usual.
So it's unless someone's got locked, if you're trapped in the Sistine Chapel right now because Italy's locked down in the middle of your tour and you can't come home to access your stuff, I guess would be a problem.
I don't know if that's the example I would have used, Scott, but
I'm just thinking I'm going to be trapped somewhere. That might not be a bad place to be trapped. If you're trapped in Italy somewhere.
Okay.
Well, and I think what's been floated is, an automatic extension. Normally, there's a form that you need to file to obtain a 6-month extension for the IRS, and what they're talking about is making that automatic. And so for your example, if you are stuck, then you wouldn't have to worry. It would be an automatic extension, where normally, if you didn't file it, you'd be late.
All right. So what are some things that people should be focusing on for their income taxes right now?
Well, I think one of the primary things I would keep in mind is, don't always get focused on whether you're going to take the standard deduction for federal and forget all your other itemized deductions. There's a lot of instances where people are ending up taking the standard deduction for federal, but they still end up itemizing for California. We have a lot of clients in California. It could be other states as well. But I do get that question a lot from our new clients of, oh, we're just going to take the standard, and they don't provide their information. And I say, well, wait a second. We need to look at it. And often is the case, we end up using their itemized deductions on the California side. And, if they had prepared their own tax returns, they may have missed out on deductions.
So is it fair to say the higher your state income tax, the greater the probability that you'll use an itemized deductions on the state tax return and not the federal?
Well, the state tax deductions aren't deductible, but for those that have property taxes and a mortgage or charity, those are the situations where you still may itemize for California.
That was what I meant to ask, was exactly that.
Okay. I figured that.
What are some other things that people should be doing differently now than maybe a couple years ago as a result of the last tax?
The Secure Act. Is it this? Yeah.
Well, I think, I think, not having big refunds is always, I think, ideal. And here's a situation where, a couple of years ago, there were delays, California issuing refunds. So I think, planning, all the time to try to minimize your refunds is ideal. Why loan the government money, whether it's the IRS or your state? And, now there's a situation where, we don't know yet, but refunds could be delayed from the IRS if those people get furloughed or, don't go to work because of what's going on right now. Refunds that people are expecting could get delayed. So that's something to think about. And then, with the Secure Act, I would just say, again, make sure, depending on what state you're in, not everything that the federal government does in terms of taxation follows at the state level. There are some key differences with the Secure Act, I know, for California. And so just, again, educating yourself, making sure before you do anything that you understand the implications.
All right. Well, hey, Michael, thank you for taking some time to be with us today. And just thought we'd catch you with changes in taxes and whatnot. Michael Marisky, he heads up Allworth Tax Solutions, and you can learn more at either allworthfinancial.com or Allworth Tax Solutions. So certainly appreciate you taking a little time to join us.
No problem. Thank you.
All right. So, it's we just have a few minutes left in the program, and it is who knows what next week will bring, right?
Yes. We would expect that the markets will continue to be extremely turbulent in all markets. I don't care what the asset class. We would expect that we're probably the probability of us entering a recession is extremely high. So the last number I read was 80+%.
How can we not? I mean,
but that's the U.S., but a global recession
how could we?
Yeah, and how could we not is exactly it. Right?
I mean, the path that we're going down, our response to the virus, whether you believe it's the right response or not,
is irrelevant.
I'm just talking about what's happening. Our response to the virus, where we're shutting everything down, you think about. I was at the Sacramento Kings game on Wednesday night. Games were being played. They had made and mentioned. As I was getting into the arena, I was actually. Full disclosure, I'm down below. I'm at a place about to buy a beer, and the NBA sends a thing that's saying beginning the next day, all games are being canceled.
So the next day,
a little tweet thing comes out, and someone tells the bartender that, and she says, "Oh no, that must be a joke." And I looked at my phone. I said, "No, sorry, it's weird." And the look on her face
yes,
right. So at that moment, I thought, "Look at the impact this is having on her." And then they canceled the game right before it started, and so I just started thinking as I'm driving home with the canceled game, and I thought, I thought about her, who was probably 30-something, might have had a kid or two at home or whatnot, about that age probably. And I thought, she relies on these tips. Bartender at an arena, she probably makes pretty good tips doing it.
Maybe her second job.
I'm sure it was. It's in the evening, right?
Right. Maybe her first job. Who knows?
So that's gone. You think about all the restaurants around the arena.
You think of all the restaurants around the United States, the service people, the people that work for airlines, the people that work in hotels, the people that work in amusement parks, the people that work in theaters, anywhere where large groups of people either travel to or meet together. Think about all the conferences that we canceled, 22 events. Well, our employees will get paid, whether we have the events or not. But all those people at the facilities that we rent, right?
We don't need you.
We don't
need you Monday night.
And
or
we'll pay
whatever.
those facilities something because we had contract with them. But
we're
that
not going to
money's
pay more than what's contracted.
correct.
No
But
company's
that
gonna do
money's not going to get down into the laborers, right? It is going to be. This is what.
It's the ripple effect through everything.
There is no part of the economy.
I
that
mean,
will
you
be
look
untouched.
at the theater district in New York shut down, right? I mean,
but I got to tell you, this may be not the right.
This too shall pass.
This may not. My kids came home and they're anywhere between 19 and 24. And
are they home already?
2 of them are, but they said, "Dad, look how cheap it is to go to Hawaii, and we could get a place at Airbnb for nothing, and we've got 5 or 6, and they're 19 and 20, and they're right. They may get coronavirus, but for them it will just be like a bad cold. And so they're like, Dad, we can fly round trip to Hawaii for $200, and 5 of us are going to rent this Airbnb for $300 a night. And I'm thinking, these poor people renting the Airbnb.
I know. There's a lot of pain.
Yeah, it is.
Obviously, there's people are going to be impacted by the virus, but there's
this too shall pass.
Everyone's feeling some financial pain on this. I think everybody will. To Pat's point, this will pass. From an investor standpoint, look, this is not a great time to be selling any sort of riskier assets. People are panicking. It might get worse. It might get a lot worse.
But it will get better.
When I started in this industry, the Dow Jones Industrial Average was around 2,600. That was 30 years ago. It's 21,000, whatever it is today. It's much higher. Anyway, we're out of time. Go to allworthfinancial.com for that video on navigating financial shocks. I think you'll find it helpful. If this podcast is helpful, forward it on to a friend. Appreciate it.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.